Something happened to silver in January 2026 that stunned even the most seasoned precious metals traders on the planet. In a single month, silver went from around $70 an ounce to $121.62, a new all-time high in nominal history. And then, within 30 hours of touching that record, it collapsed more than 30%. Not in a week, not over several days, 30 hours. That kind of violence, that kind of speed, does not happen randomly. It is the signature of a market under enormous pressure from multiple directions at once. And right now, in June 2026, as silver trades back in the mid-60s after the dust has partially settled, a quiet but serious conversation is taking place among institutional investors, monetary analysts, and historians of financial markets. That conversation keeps returning to one single moment in history as its reference point. Before we go any further, I want to ask you something, because your answer matters to what follows. When you look at silver right now, after a 147% rise in 2025, after hitting a nominal all-time high in January, after a violent correction, and now trading around $66 an ounce, does this feel to you like a market that got ahead of itself and is correcting? Or does it feel like something bigger is still unfolding underneath? Hold that thought, because the answer you give actually determines which historical map is most useful for understanding where this could go next. There is a moment in the late 1970s that financial historians return to again and again when they try to understand what silver does under extreme monetary stress. And it is a moment that a growing number of serious analysts are now using as a framework, not a roadmap, not a guarantee, but a framework, to think about what silver may be telling us today. That moment is 1979. And to understand why it matters, you have to understand the full picture of what was actually happening then. Because most people only know the headline. Cast your mind back to the United States in the mid-1970s. The gold standard had been fully abandoned just a few years earlier, in 1971, when President Nixon closed the gold window and ended the convertibility of the dollar. For the first time in modern history, the world's reserve currency was backed by nothing except the promise and credibility of the government that issued it. What followed was years of monetary instability, 2 devastating oil shocks, and a Federal Reserve that kept blinking, raising rates when things got bad, cutting them when growth wobbled, never quite having the resolve to do what needed to be done. By 1979, the result was a CPI inflation rate that had touched 13 and 14%. Not the inconvenient 2 or 3% we complain about today, 13, 14. Your savings were being visibly, painfully destroyed in real time. That was the environment when 2 brothers from Texas, Nelson Bunker Hunt and Herbert Hunt, began accumulating silver. Not because they invented the trade, not because they dreamed up the idea of a monetary hedge. They responded to conditions that already existed. They stepped into a market where real people, ordinary Americans and institutions alike, were genuinely afraid for the purchasing power of their money. Silver went from roughly $6 an ounce at the start of 1979 to nearly $50 by January 1980. Gold moved in the same direction, though less dramatically, briefly crossing $800. And then Paul Volcker arrived as Federal Reserve Chairman and did something that no central banker had been willing to do for years. He raised interest rates until they hurt. The federal funds rate eventually climbed toward 20%. It was brutal. It caused genuine economic pain. Unemployment rose sharply. The housing market was damaged. But it broke the back of inflation. And it ended the hard asset trade, because suddenly holding bonds and cash started making sense again. Silver collapsed from near 50 back below $11 within a year. That is the story most people know, and they tend to stop there. But here's the part that matters for today, and it is the part that gets lost in the simplified version. The Hunt brothers did not create the conditions, they exploited conditions that already existed. The monetary anxiety, the dollar credibility crisis, the investor fear about where paper money was heading, all of that was real and already in motion before the Hunts made their move. The Hunts amplified it, they concentrated it. And when COMEX changed its rules in January 1980 by restricting new leveraged long positions, the speculative overlay collapsed. But the underlying conditions, the monetary reality, had already been met by Volcker's intervention. This is the distinction that matters enormously for how we think about today. Because the question is not simply whether silver is going up, it is why it is going up, and whether the underlying conditions are truly comparable. Now here is where the story becomes more interesting, because 2026 is not 1979. The world is different, the tools are different, the players are different, and several of the most critical conditions from that era are either absent, transformed, or operating in ways that have no clean historical parallel. Let us start with what is genuinely similar, and the first similarity is one that most retail investors underestimate because it does not show up in a single price or a single chart. It shows up when you step back and look at the full fiscal architecture of the United States. The U.S. national debt has now crossed $36 trillion. As a share of GDP, publicly held debt is at approximately 101% right now in 2026, according to the Congressional Budget Office, and the CBO projects that number rising to 120% of GDP by 2036, well above the previous all-time record set after World War II. More striking is what the U.S. government spends just to service that debt. Net interest payments in fiscal year 2025 exceeded what the United States spent on national defense. Not approached it, exceeded it. The U.S. Government Accountability Office, in a report released just this month, described the fiscal trajectory as unsustainable and projected debt reaching 123% of GDP within 10 years if nothing changes. Now, in 1979, the concern was not just current inflation. The deeper anxiety was about whether the government could actually manage its obligations without ultimately resorting to inflation as the mechanism. That concern is arguably more mathematically grounded today than it was in 1979. The numbers are larger, the structural imbalance is more deeply embedded, and the options for resolving it, genuine spending cuts, meaningful tax increases, or growing your way out, all carry political costs that no administration has been willing to fully absorb. This does not mean inflation is inevitable. It does not mean the dollar is collapsing tomorrow. But it does mean that the underlying condition, a sovereign balance sheet that invites questions about long-term monetary credibility, is clearly present. Perhaps more clearly present than at any time since the 1970s. The second parallel is one that operates largely beneath the surface of mainstream financial media, but institutional money watches it extremely carefully. It is the behavior of the world's central banks. In the late 1970s, central banks were quietly recalibrating their relationship with gold following the collapse of the Bretton Woods system. For the first time in a generation, there was no gold anchor to the global monetary system, and reserve managers were adjusting to a world of floating currencies. Something structurally similar is happening now, and it has been building with remarkable consistency. According to the World Gold Council's 2026 Central Bank Gold Reserve Survey, the largest participation in that survey's history, with 76 central banks responding, a record 45% of reserve managers said they intend to increase their own institution's gold holdings in the next 12 months. 89% believe global central bank gold holdings will keep rising, and 74% expect the dollar's share of global reserves to be moderately or significantly lower 5 years from now. But what they said about where gold is heading compared to the dollar is perhaps the most telling detail. They do not expect the euro or the Chinese renminbi to fill the gap. They expect gold to fill it. Gold has now overtaken U.S. government bonds as the top reserve asset globally for the first time since 1996, according to Morgan Stanley research. That is a historic shift, and central bank net purchases in the first quarter of 2026 reached 244 tons, up 17% from the previous quarter. For silver investors, this matters enormously, because silver historically moves in the same direction as gold during periods of genuine monetary stress, but it tends to amplify that move. The gold-to-silver ratio tells part of this story. When silver hit its all-time high in late January 2026, the ratio compressed to around 50-1, a level not seen since 2013. It has since widened back to around 62-1 as silver corrected more aggressively than gold. Historically, a ratio in the 60s has marked transition periods where silver starts to close the gap with gold's monetary repricing. Now here is a question that most silver discussions are not asking honestly enough, and it changes everything about this comparison. Is this silver move primarily a monetary story, the way 1979 was? Or is it something different? Something that 1979 has no real equivalent for? Because there is a second engine driving silver in 2026 that did not exist in any meaningful form in 1979, and it does not operate on fear. It operates on factories. The Silver Institute and Metals Focus, through the World Silver Survey 2026, confirmed that the global silver market is now in its 6th consecutive year of structural supply deficit. Let that sink in. 6 years. The 2026 shortfall is projected at approximately 46 million ounces, and that is after 5 prior years of deficits that cumulatively drew down above-ground stockpiles by nearly 820 million ounces between 2021 and 2025 alone. Total mine production globally runs at roughly 813 to 844 million ounces per year, but total demand has been running well above 1 billion ounces annually. The math is not complicated. Supply cannot meet demand. And unlike monetary silver demand, which can vanish overnight if investor sentiment turns, industrial demand has a different character. It is driven by technology adoption curves and long-term energy infrastructure commitments. Solar panels, electric vehicles, AI data centers, high-speed computing hardware, all of these consume silver in ways that were either non-existent or negligible in 1979. Each electric vehicle uses 25 to 50 grams of silver, 67 to 79% more than a conventional internal combustion vehicle. AI data centers are consuming an unprecedented volume of precision electrical components that rely on silver's conductivity. And while solar panel manufacturers have been reducing the silver content per panel through thrifting, the sheer scale of global solar deployment is expected to keep baseline photovoltaic silver demand structurally elevated for years. This is the part that makes 2026 fundamentally different from 1979, and it works in silver's favor. In 1979, if you removed the monetary anxiety, silver had no industrial foundation powerful enough to sustain elevated prices. Today, that foundation exists and is measurable. The Silver Institute's own projections anticipate continued deficits through the foreseeable future. But, and this is crucial, it also means the comparison to 1979 is genuinely more complex than it first appears. If you are watching this channel and thinking through precious metals seriously, I want to pause here for a moment because this kind of analysis takes time to research and present honestly. If you find that this kind of deep, data-driven look at financial history is useful to you, it genuinely helps when you subscribe, not because of an algorithm, but because it tells us this kind of serious work is worth continuing. There is a lot of noise in financial media. Very little of it traces the real mechanisms. If you want more of this, subscribing is how you let us know. Back to the core question. If both engines are running, the monetary anxiety engine and the industrial demand engine, that creates a combination that the 1979 comparison simply cannot fully account for. And it potentially makes the case for silver more structurally durable than the 1979 move was, which was essentially a pure monetary trade amplified by speculative leverage. But there is a third factor, and this one is where the honest analyst has to slow down and be very careful. Because it is the factor that, more than any other, explains why 1979 happened the way it did, and why the same thing may or may not happen again. In 1979, the Federal Reserve had lost something. It had lost credibility. Year after year, it had promised to fight inflation. Year after year, it had blinked when growth slowed, cutting rates before inflation was truly defeated. By the time Paul Volcker was appointed in August 1979, the Fed was an institution that markets had simply stopped fully believing. And that credibility vacuum is what gave the hard asset trade its power. When you cannot trust the central bank to protect the purchasing power of your currency, you move into things that cannot be printed. Gold, silver, real estate, commodities. The Federal Reserve today is a genuinely different institution. Whatever criticism you may have of its decisions since 2020, and there is legitimate criticism to be made, it demonstrated during the 2022 rate hike cycle that it was willing to cause real economic pain in service of inflation control. The most aggressive tightening cycle in 4 decades. Mortgage rates doubled. Regional bank stress emerged. Small business lending was constrained. The Fed kept tightening anyway. That is not the behavior of a central bank without resolve. As of June 2026, 9 of the Federal Reserve's 19 policymakers are projecting at least one additional rate hike before year-end. Markets have been pricing in a potential increase as early as September. Core PCE inflation in May came in at 2.9%, still above the Fed's 2% target, while headline inflation has been running higher. The Fed is not accommodating inflation. It is fighting it. This is the single most important difference between now and 1979, and it cuts against the most dramatic versions of the 1979 comparison. If the Fed maintains its credibility, if markets continue to believe that any serious inflation resurgence will be met with serious rate hikes, then one of the core conditions that made 1979's hard asset move so powerful is simply not present in the same way. The monetary fear premium for silver has a ceiling as long as that credibility holds. But here is where the analysis gets genuinely complicated, and it is the part that sophisticated investors are watching most carefully. The Federal Reserve's credibility has always been conditional. It depends on the government's fiscal path, creating a space where monetary discipline is actually sustainable. In 1979, the fiscal situation was bad. Today, the fiscal situation is arguably worse in structural terms. The CBO projects that interest payments on the federal debt will consume 3.3% of GDP in 2025, approaching the previous all-time high. And it projects that figure rising to 4.6% of GDP by 2036. There comes a point, not tomorrow, not necessarily next year, but at some point, where the cost of maintaining high interest rates begins to conflict directly with the government's ability to service its own debt at a manageable cost. When that tension becomes visible to markets, the central bank faces an impossible choice: fight inflation and accelerate the fiscal crisis, or ease monetary policy and risk reigniting the inflation it just defeated. That is the scenario that the 1979 comparison anticipates. Not where we are today, but where the trajectory points if current fiscal policy continues unchanged. Now here is the question nobody is asking clearly enough. How does the January 2026 silver crash fit into all of this? Remember what happened. Silver went from around $70 to $121.62 in a single month, the fastest monthly gain since, remarkably, the 1979 Hunt Brothers peak. Then it collapsed more than 30% in under 30 hours. Then it corrected further to below $64 by early February, before stabilizing and recovering toward the upper 60s and lower 70s where it trades today. Was that peak a genuine signal? Or was it a speculative overreach that distorted the underlying story? The evidence points toward the latter for the peak itself, but not for the underlying fundamentals. The Silver Institute's own language in the World Silver Survey 2026 is telling. Analysts noted that the rally to $121 was driven in part by a liquidity squeeze in physical markets, speculative leverage in paper silver derivatives, retail fervor, and product shortages at dealers. The Silver Institute itself described the rally as exceptionally fragile. When that leverage unwound, it unwound violently. But the structural case, the supply deficit, the industrial demand floor, the central bank gold buying backdrop, the fiscal trajectory, none of that changed in January. The correction changed the price, not the fundamentals. And the correction actually eliminated something potentially dangerous, the speculative overlay that was making the market fragile. Silver at $66 in June 2026 is a very different market than silver at $121 in January. The speculative froth has been removed. What remains is closer to the fundamental picture. The honest framework for thinking about where this goes next comes down to three variables, and each one has a range of possible outcomes. The first is the trajectory of real interest rates. As long as real rates, meaning interest rates adjusted for actual inflation, remain near zero or negative, the opportunity cost of holding silver stays low. The monetary premium can sustain itself. If the Fed succeeds in pushing real rates meaningfully positive and keeps them there, that premium comes under pressure. This is the key variable to monitor. The second is the structural supply picture. 6 consecutive years of deficit have drawn down above-ground stockpiles to levels that the Silver Institute describes as increasingly tight. LBMA delivery delays have been documented. COMEX vault dynamics have reflected this tightness. If physical scarcity becomes an acute issue, rather than a slow-building backdrop, it can amplify price moves in ways that are difficult to model in advance. The third, and perhaps most important, is what happens the next time a genuine financial stress event hits. Does the Federal Reserve prioritize inflation control, even if that means deeper economic pain? Or does it prioritize financial stability, even if that means accepting some additional inflation? That choice, when it arrives, will be the single most informative data point for whether the 1979 comparison has real teeth or whether it remains an interesting but ultimately incomplete parallel. There is one more comparison that deserves honest attention, because ignoring it would be intellectually dishonest. And that comparison is 2011. In early 2011, silver ran from around $18 to nearly $50 in roughly 5 months. It was explosive. It had genuine macro justification, quantitative easing, post-financial crisis debt anxiety, a weak dollar, and it collapsed. By late 2011, silver was back below $30. By 2015, it was below $16. The 2011 move was partially a real story and partially a speculative overshoot. And when the speculative froth cleared, the correction was severe and sustained. The January 2026 peak of $121 may have had some of those 2011 characteristics. The speed was extraordinary. The leverage was evident. The subsequent correction was brutal. But there are two things in 2026 that 2011 did not have. The first is 6 consecutive years of documented physical supply deficits. In 2011, the silver market was not in structural deficit. The second is the combination of industrial demand drivers, solar, EVs, AI infrastructure, that create a real consumption floor that pure monetary fear cannot. In 2011, silver had no such floor. None of this means silver cannot go lower. It can. Real rates could move sharply positive. A global recession could weaken industrial demand. A geopolitical resolution could reduce safe haven demand for precious metals. A technological shift could reduce silver's role in photovoltaic cells. These are real risks, and they deserve serious weight. But none of those risks change what is documented in the supply and demand data. The Silver Institute's World Silver Survey 2026 projects a 6th consecutive annual deficit. The cumulative drawdown of above-ground stockpiles from 2021 through 2025 is nearly 820 million ounces. That is a physical reality, not a narrative. And physical realities do not resolve themselves through price movements alone. They resolve through time and supply response. Mine supply does not respond quickly to price signals because approximately 70% of global silver production comes as a byproduct of copper, zinc, lead, and gold mining. Higher silver prices do not automatically mean more silver mines get built. So where does this leave us, honestly? Silver in June 2026 is a metal caught between two legitimate stories that are both operating simultaneously. The monetary story, sovereign debt stress, central bank gold buying, dollar credibility concerns, is real and has genuine historical precedent in 1979, even if the specific conditions are different. The credibility gap that enabled 1979's most extreme moves is not yet present today, but the fiscal trajectory that could create such a gap is visible and documented. The industrial story, structural supply deficits, technology-driven demand growth, physical tightness in key markets, is a new element that 1979 had no equivalent for. It creates a floor that the 1979 move never had. It also adds complexity and additional variables that can disrupt either a bull or a bear case. The January 2026 peak at $121 may have been a preview of what the intersection of both stories could look like under acute conditions. The correction that followed, bringing silver back to the mid-60s where it trades today, may represent exactly the kind of consolidation that precedes the next phase. Or it may represent the beginning of a longer, slower unwinding. We do not know yet. The honest analyst does not pretend otherwise. What we do know is this: the investors who navigate markets like this correctly are not the ones who make confident predictions. They are the ones who understand the specific mechanism behind the price move, who track the right variables, who size their positions with full awareness of what can go wrong, and who are not surprised by either the upside or the downside when it comes. Watch real interest rates relative to actual inflation. Watch the behavior of the gold to silver ratio. If it continues compressing from its current 62-to-1 toward the historical median range, it suggests the monetary repricing is continuing, not stalling. Watch how the Federal Reserve communicates when the next stress event arrives. And watch the physical silver market. If LBMA delivery delays become more frequent, or if COMEX inventory dynamics become acute, the structural story is accelerating. History does not repeat in finance, but it does occasionally rhyme. The investors who understand why 1979 happened, not just what happened, are better equipped to recognize whether today's silver market is rhyming with that era, or whether it is writing an entirely different verse. The question for you now is the same one serious investors have been sitting with since this cycle began. Is this a monetary story wearing an industrial costume, or an industrial story wearing a monetary costume? Or something genuinely new, a market where both forces are real, both are measurable, and both have the power to move price in ways that neither could alone. Let us know in the comments below, not what the price is going to do, that nobody knows, but which story do you think is primarily driving silver right now? The monetary case, the industrial case, or a combination of both? The quality of that debate in the comments section matters because it forces a clarity of thinking that most financial media does not encourage. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in.